Hello everyone, how are you? Welcome back. I'm Dr. Labib. Today we are going to cover ACCA financial reporting. Just before the examination, we will start doing mock examination. This mock examination will be in 3 or 4 parts. Okay, Section A will be dealt today. Section A, Section B, and Section C. We will do it separate. Section A one session, Section 2. Section B one session, and Section C we will see how it will be worked out. I kindly request you all to subscribe to this channel so that whenever I will post it, you will get the bell notification, and you can just press the bell icon. The only purpose is to reach as much as possible. Your comments, your suggestions, any ideas for improvement, please post it in the comment box. Any idea, I will be very much pleased to welcome these comments, and hopefully we'll add those things in the future videos as such. This time we are talking about, you can also watch F7 financial reporting, F8 financial audit and assurance, and SBR strategic business reporting. Okay, from my side. I post all the videos over a period of time. Fine. That's what is the how the things will progress. Is it? The mock exam is divided into 3 sections: Section A, Section B, and Section C. Section A is going to be 15 questions, mostly theoretical and little bit application. Section B consists of 15 questions with respect to 3 parts. Is it right? 3 scenarios. Is it 3 scenarios? Scenario based questions. 5 questions each. 5 MCQs in each scenario. Is it right? Each scenario. And you will have Section C. We have 20 marks, 2 questions. It comes to 40. Okay, here you will have 30 marks, here you will have 30 marks, here you will have 40 marks. Total it is going to be 100. And keep it in mind, the all questions must be attempted. Okay, that's very, very important. We have to be little bit careful, very specific on that how this will have its impact as such. Fine. Now let's start. Again, I request you to kindly subscribe to this channel, and anything is there, just keep me posted with your suggestions and comments. Fine. Now, what is today? We are going to talk about only Section A. Okay, Section A. 15 questions will be there. 15 questions will be there. Fine. Now, what they are saying: which of the following should be capitalized in the initial carrying amount? Means when you often plant is, we are talking in terms of IAS 16, is it? Property, plant and equipment. We are talking in terms of capital expenditure, is it right? Capital expenditure. When you say capital expenditure, see, we have a pre-operative, and post-operative. Is it right? Pre-operative expenditure and post-operative expenses. If it is pre-operative expenses, till the installation, we have to capitalize. Okay, and we have to capitalize, and we have to show it in the statement of financial position. We have to show in the current, non-current assets as per IAS 16. Whereas if it is going to be post-operative, it has to be shown in the profit and loss account as expenses. This is the basic background. Now, based on that, what they have given us 4 different options. Cost of transporting the plant to the factory. Yeah, it is, when we say it is going to be, it is a pre-operative. We are transferred, it will add it will add the cost to the plant. Still, it is not in operations. Fine. Still, it is not in operation. We have to take it. Cost of installation of new power supply. We are talking about we need supply for that. Is it new power supply? Is it? We are not taking into anything about repairs. Nothing like that. We are talking about the new. We are starting for the first time a long term. Is it right? And it is for the new factory to operate the plant. It is also going to be capitalized. They say that which of the following should be, okay? Cost of 3-year maintenance. Maintenance is going to be operating expenses. It happens on a yearly basis. Is it right? It have a year maintenance cost, yearly basis. Any yearly basis, it is a operating expenses as such. Fine. Now, cost of 3-week training courses. It is staff training. Is it? Staff training also, it is a continuous. It is a continuous process. Fine. It is periodic process. Every year it happens. Is it? It will see staff. When we are talking about the staff, paying to the staff, it is salaries. Is that training cost is also it is the things which are going to be treated on a yearly basis. So that is also not there. The answer is what? The answer is 1 and 2 as such. Okay, means now you can understand. Pre-operative cost you have to capitalize. Post-operative cost we have to expense. Is it right? Post-operative cost we have to expense. Is it? This is the basic. Difference. Very important, and they will test 1 or 2 questions on. 1 question will be there. Is it? Now, when a parent is evaluating the assets of a subsidiary, fine. Certain intangible assets can be recognized separately from goodwill. Some intangible assets, brands, patents, like that, even though they have not been recognized in the subsidiary own statement of finance. Subsidiary own statement of finance. In the subsidiary it will not be there, but when you are talking in terms of the parent company, when a parent is evaluating the assets of the subsidiary, some assets will be apart from goodwill. Which of the following is example of a intangible asset of the subsidiary which be recognized separately from goodwill when preparing the financial statement? See, when we are doing the things as how we have to identify the intangible apart from goodwill. Is it a new research project? See, what is intangible asset? Intangible asset means it has to it has to generate revenue. Is right? It has to generate revenue, and it is going to be over a period of time. A new research project which the subsidiary has correctly expensed to profit and loss. See, research will be expensed. Is it right? And development will be capitalized. Is it? Basic core difference. Fine. A research project which is subsidiary has correctly expensed to profit or loss, but the directors of the parent have assessed it have a substantial fair value. Is it? Means the subsidiary has done appropriately, but parent was ultimately the parent company will have its own judgment. Okay. Now, a global advertising campaign which was concluded in the previous financial year from which benefits are expected to flow in the future. See, when you are talking about a advertising campaign, is it right? When you are talking about the advertising campaign, it is basically expenses. Right? Basically expenses. There is nothing like we cannot ever think about it. A contingent asset. Contingent still it is the contingent maybe or may not be from which the parent believes a flow of future believes, okay, see, words are very important. Believes a future economic benefit is possible, still it is not uncertain, still uncertainty is there. Is it? When there is a uncertainty, it will not work. When there is about the Kulu advertising campaign, again we should not consider. A customer list, we have list with the directors are unable to value. See, it is a customer list, is it? That is the database. That is not in some cases. See that now, if you see the current trend, the most important thing that is the database. But we are talking in terms of a specific intangible assets. Means this is also not workable. What is the thing? A research project has been correctly expensed to profit and loss account, but what the directors of the parent company say that it may have a substantial fair value, can be treated as a intangible asset. Fine. Now, point number 3. On October 1st, the Flash company acquired a plant under 5-year lease agreement. Under the terms of agreement, an immediate deposit of 2 million is payable on inception of the lease, and the present value of the lease payments are how much? Present value is 25 to 72,000. Annual rentals are 6 million for the 5 years, and agreement is going to be how much? Implicit rate is how much? 5% per annum. What they are asking us, the current liability. Yeah? These type of questions, either it will be there in the section A, section B, or in section C also. They will be reflected. Okay, what is the current liability? How much is there? We have to see. You need working for that. Yeah, you need working for that. There is a year. You will have the opening balance. Is it? You have the opening balance. You have to take the interest at the rate of 5%. My videos are, I've already posted my videos related to this. Okay, just go through it before you do the mock exam. Okay, and subscribe to this channel. That's that's my personal request. Is it right? Payment, fine, payment, and you are talking in terms of a closing balance. Okay. Now here what they say, on October 1st, 2004, they acquired a 5-year lease agreement. What immediate? How much they are paying? 2 million. Okay, and as on the inception of the lease, and the present value of the lease payments on that day has been calculated how much? 25 to 72. Is it right? This is happening when? This is happening on, if you take October 2004 also, to October 1st, 2004 to 30th September 2005. Okay, 30th September, 1 year will be end there. Okay, 30th September 2005. Opening balance is how much? 25 to 72. Okay, interest at the rate of how much? 5%. Fine. Interest 25 to 72 into 0.05. Okay, into 0.05, it comes to how much? 25 to 72 into 0.05, it comes to how much? 1,263,600. Okay, how much will come? It comes to 1 2 600. Okay, 1,263,600. Payment is how? See, when we are doing this, this is column number 3, this is column number 2, this is column number 1, this is 4, this is 5. Okay, payment is how much? Payment is, they are making a payment of how much? They are making payment of 6 million. Fine. They are making a payment of 6 million. Column 1 2 3 6 1 1 2 1 2 3 6. Okay, now what is that? 25 to 72 is it 25 to 72 plus 1263 600 minus 6 million. $25 to 72, okay, plus 1263 600 minus 6 million. Okay, this is how we have to put 2 plus 3 minus 4. Okay, 2 plus 3 minus 4, it comes to how much? 25 35 600. Fine, 25 35 600 as a next. Now what we want to know the current liability, is it? 30th September. What is the current liability which you are going to pay in the next year? Okay, we are ending on 30th September 2005. What is the current? How much is the opening balance? 25 35 600. Okay, 25 35 600. 25 35 600 times 0.05, is it? 0.05. How much will get? 1012 780. Okay, 101012 780. How much they are paying? They are paying 6 million. Is it? They are paying how much? They are paying 6 million. It comes to how much? It comes to 15. 2 plus 3 minus 4, 15 548. Okay, 15 548 380. Right? What is the current liability? Current liability is 25 35 600 minus 15 548 380. Is right? It comes to how much? 4987 220. Is right? This is the current liability. What is the closing balance of 2005 minus the closing balance of 2006? The difference is going to be the current liability. How much is there? 4987 380. 4987, sorry, 4987 4987 4987, 1 minute. 4987 4987 220. 4987 220. Fine. This is the way we have to do it. Next, financial. These are a conceptual question. Okay, the financial statement represent transaction in words and numbers. To be useful, financial information must be represent faithfully of these transactions in terms how they are reported. Identify by selecting the relevant box in the table below whether the statement regarding faithful representation is true or false. Charging the rental payment for an item of a plant to the statement of profit and loss account, to the where the rental agreement meets the criteria. We are talking in terms of, see, rental payment is different, is it right? Rental payment and lease payments. Okay, lease payments. We should have a clear distinction. We cannot put the rental agreement in profit, and we have to keep rent. Rent is an expense, is it? Whereas the lease, we have to reduce the value of the lease assets. Is it? We cannot put the things in the lease and rental. We cannot mix it up. Is it? We cannot mix it up. This is false. Including a convertible note in equity on the basis that the holders are likely to choose the equity option on, see, likely to choose. See, when you are having a convertible loan note, is it? When you are having the convertible loan note, at the time what will happen, that is important, is it right? We cannot say that we cannot put it, we cannot decide now, is that when it has going to be matured, when it is going to be that option is going to be exercisable, then only in that situation we can make a decision. But right now we cannot make a decision. Treating redeemable preference shares as part of equity in the statement of financial statement position. See, you cannot treat redeemable preference shares are different, equity is different. Okay, substantially, if you see the difference between preference shares and equity shares, it is a huge difference, is it right? In the treatment, everything conceptually it is different. Fine, conceptually, basically, fundamentally, practically, application in any way you take it, it is going to be completely. You cannot treat the preferentials as a part of equity. Fine. De-recognizing factor trade receivable sold without recourse to the seller. Once it has been sold, definitely you have to de-recognize the factor trade receivable, because once it has been sold, done. Are no longer going to be an asset of the seller, and therefore the statement is, it is once you are sold the thing, then it is not going to be treated as a current asset. It is true. Yeah? This is the way you have to be very, very careful in making the judgments with respect to the questions. Now, what they say on October 1st, 2004, Kalatra company commenced drilling an oil from undersea oil field. Kalatra is required to dismantle the drilling equipment after 5 years of license. This is estimated how much? 10 million, 30 million. Okay. When it has been there, it is on October 1st. October. Dates are very important. Fine. Dates are the moment in the examination you will come across. First, underline the dates. Okay. And you see October 2004, 5, 6, 7, 8, 9. You get 5 years. Okay. 5 years. Kalatra cost of capital is how much? 8%. And one for if they give like this, they have to see what is the present value of that amount as a 30 million present value. Fine. You have to see what is the 13 million present value. Select your answer from the drop and drop, pull down box. Okay. How much? That's why we have to know the present value of the estimated dismantling cost. Is it an estimated dismantling cost? And my handwriting is not that much. Okay, 30 million. Okay, 30 million. No? Yes, 30 million. I will take zeros. Okay, I will take zeros into times 0.68. Okay, you will get the present value. How much you will get present value? You will get a present value. Here they have mentioned no. How much you will get present value? 20,400,000. Fine. 20,400,000. On this you have to add the interest. Is it right? At the rate of how much? You have to add the interest. Add interest. Interest at the rate of how much? Interest is at the rate of 8%. Is it right? Interest is at the rate of 8%. Interest at the rate of 8%. 2,400 times 0.08. Okay, 0.08. It comes to how much? It comes to 1632,000. Fine. 000230122. Is right? How much is there? 22,032. Simple. You have to calculate the present value. On the present value, you have to calculate the interest. Automatically, it will be reflected. Fine. Next. Next. What is the when a single entity purchases or sells in a foreign currency, it will be necessary to translate the transaction into functional currency, foreign currency transactions. Okay. Before you see the thing, see videos. I have posted videos on this foreign exchange rates. Okay, I have posted the videos on this. Please go through the videos. You will know. The moment you go through the videos, automatically these questions will be relatively easy for us. Before the transactions can be included in the means which yes, we translate the currency into how we have to translate the function in accordance to IES 21. The effect of change in foreign currency exchange rates. I posted one video on this. One or two videos are there. Which of the following foreign currency rates may be used to translate? Whenever we see foreign currency always changes, is it right? It is always changes, and there are conditions are there which rate has to be used whenever we are making the translation. Okay, the rate which exists on the day the purchase or sale took place. Is it? See what happens, what they are saying, which type of transaction they are talking about. They are talking in terms of purchases and sales. Okay, when they are talking about purchases and sales, is it right, will happen all through the year. Is it all through the year? And when we are taking into consideration all through the year, definitely as per the rule we have to take the average rate. Is it right? We have to take the average rate as such. Yeah? We have to take the average rate, or we have to take, what is the option? We have to take the transaction date rate. Is it? Transaction date rate. Very, very clearly, is it? Now, what it says, is it? What it says, to the rate at which is existed on the day the purchase or sale took place. Fine, okay? Means what we are talking transaction day, is it? The rate which exists at the beginning of the account. No, we cannot take the beginning. For this, it is not applicable. For sales and purchases, the opening rate is not applicable. An average rate for the year we have mentioned here, is it? We have mentioned here is an average rate. We are saying it is a rate on the transaction day. Is it? The average rate for the provided there have been no significant fluctuations to the year. Yeah? The rate which is existed at the end. We should not take the beginning rate. We should not take the ending rate. We have to take the rate as on the date of transaction, or we have to take the rate as on the average basis as such. Fine. Now, on October 1st, 2004, Hoy company has 2.5 million shares, equity share, $2.5 million. Okay. How many shares are there? 2.5 divided by 0.5 cents. It comes to how much? 5 million shares. Okay. It comes to how much? It comes to 5 million shares. 2.5 shares of say. No new shares were issued during the year ended 2005. But on that day there was an outstanding share option which diluted effective the issuing of how many shares? 1.2 million shares. Is it right? 1.2 million shares. Fine. Now, his profit after tax is how much? 1.555. what is the earning per share as per IES 33, and what high diluted per sharing for the diluted earning per share. How many shares are there? N. Okay, N is how much? 2.5 million divided by 0.5. It comes to how much? 5 million shares. Is it right? Next, new what they say? They say that it is going to be a options are there. How much options are there? 1.2. Fine. 1.2. Total it will come to how much? 6.2. Okay. 6.2. This is the N. Is it? EPS. What is the formula for EPS? EPS is nothing but what they say, profit after tax divided by revised. Okay. Revised number of shares. How much is the profit after tax? 1550 divided by 62000. It comes to how much? It comes to how much? 0.25. Here 0.25. Okay. Now I'm taking very slowly. Okay. I will not rush. I'm not rushing. Ford company owns 80% of the investment in spoon. Fine. Is it right? Fork and spoon. How much is there? 80%. Fine. Which is purchased several years ago. The goodwill on acquisition is how much? 674. And there is no impairment of goodwill in acquisition. On 30th September, they disposed of entire investment in spoon. Okay, they have disposed of. Details have been given. Sale proceeds is 5 this much. Cost of entire investment is this much. Fine. Immediately before the disposal, the consolidated financial statements of 4 include following: carrying amount of net assets is this much, and carrying amount of NCI is how much? This much. What is the profit and loss on disposal? Very interesting question. Okay, very interesting, very conceptual question. Okay, conceptual and very interesting question of folks. Statement of it. How much they have sold it. Sale proceeds. Is it right? Sale proceeds are how much? Sale proceeds are 5580. Is it right? Sale proceeds are how much? 5580. Now next, net assets at disposal. How much? Net assets at disposal at the time of disposal. How much? They have say 4464. Is it right? Goodwill at disposal is how much? Goodwill at disposal. Goodwill at disposal how much? 900. Goodwill at disposal is how much? Goodwill at disposal is how much? 1674. Okay, good. 1674. So we are taking it in thousands. Okay, we are taking it in thousands. Goodwill at disposal is how much? 1674. Okay, less carrying amount of the NCI is how much? Carrying amount less carrying amount of NCI is how much? Carrying amount of NCI. Carrying amount of NCI is how much? 900. We have to remove this. Is it right? Then we can say whether we got the profit or we got the loss. Is it? How much we'll get? We'll get 4464 plus 4464 plus 1674. Is it right? 1674 minus 900. It comes to how much? 5238. How much is the difference? Difference is 342. Yeah, we'll see 42. Yeah. How much is it? It is 342. Is it? Profit is how much? 342,000. Okay, 342,000. Slowly and steadily you do. I will take a lot of time and explanation. You should have patience and see till the end. Okay, till the end, and you see it. Just even two marks are important. Every mark is important. Consolidated financial statements are presented on the basis of companies within the group are treated as they have a single common entity. Fine. Which two of the following means when we are making a consolidated financial statement, we will group the things irrespective of whichever business it is there, whatever is there. Is right? You will have multiple businesses, multiple areas, diversified, all the things. Is it right? But when we are making a consolidation, it is a single economic entity. Which of the following requirements are of preparing consolidated financial statement? Is that which? All subsidiaries, okay? All subsidiaries must adopt accounting policies of the parent in the individual. There is no, see, accounting policies will differ, is it right? Will differ from, see, it's not, you can, there is no, you see, methods will differ, policies will differ, valuation, presentation will not differ, only the methods will differ, is right? There is no hard and fast rule that you should, there is nothing like must, is it right? It is not that much rigid, is it right? You have a flexibility, is it right? You have the flexibility based on the assumptions. There is no must, there is no precondition is there. Subsidiaries with activities are substantially different to the activities of other members of the should not be. Why we not consider all that? We are not, see, they are asking us what? They are asking us two things, is it right? They are asking us which are two. This is also, we cannot say should not be consolidated. Means we cannot have a consolidated statement for 50% of the company and 50% of the company. Is it right? We cannot have. Is that we cannot see like this? We cannot have. You will have a parent company. You have a lot of subsidiaries. Is it right? You have 1, 2, 3, 4, 5, 6 subsidiaries are there. All these are subsidiaries. One we are saying we cannot say that. Yeah, we will do a consolidation for these 3 different, and then we can. There is no meaning. Okay, we cannot get any reasonable outcome as such. Okay, this is not applicable. All entity, even both first two are wrong, read the next two options. All entity financial statements within a group should normally prepared to the same accounting year, that's very important, and period to consolidation. That's fine. You have to mean consistency, periodicity is concept, is it right? Concept of periodicity. Is it? Consists of periodicity, correct period, means accounting period. Unrealized profit within the group must be eliminated. This is what we are doing all through the time, is it? Portion of unrealized profit. Portion of unrealized profit must be eliminated. What are the two answers? Answer 3 and answer option 3 and option 4. Now, what they say, dashing group sells goods to its 80% own service dancer company during the financial year, some of which remains in inventory. Fine. So using the drag and drop option, select the correct adjustment required. What happens whenever whenever there is goods which have been remain unsold, you have to reduce the inventory. Fine. You have to reduce the inventory. Is it? Your inventory has to be reduced. Inventory has to be reduced. Profit has to be reduced. Is it right? Profit. Now, in order to reduce the asset, is it right? In order to reduce the asset, you have to, what you have to do? You have to credit the asset. In order to reduce the profit, what you have to do? You have to debit the profit asset. Means debit will be what? Debit will be group retained earnings. Is right? Credit, debit, group retained earnings. See, I am teaching in a in a way actual class will happen. In that way I will teach. Okay, so the handwriting, everything you have to so I will not put artificially putting in the something typing the things, all those things. I can do that, but I will want to make it as you feel you are attending a class. Okay, that is the credit. What credit you have to increase? Credit is you have to decrease the asset. In order to decrease the asset, you have to make it as a inventory should be credited. Fine. Caddy company acquired 240 of 800,000. Just imagine how much is the 240 of 800,000. 240 of 800,000 is 30%. Is it right? At how much? 6% share on October 1st. Dates are very important. Okay. Amble profit for the year is how much? 400,000. See, Caddy acquired. Is it right? Caddy acquired Ambles. Okay, Ambles. How much they acquired? They acquired 30%. Fine. Okay. When they have acquired, they acquired on 1/10/2004. At that time, what is the profit? Profit is how much? 400,000. And they paid an equity dividend. Fine, good. That's very important. The more 150,000. The more the particulars are there, the more the clarity will come. Okay, for understanding. Okay, fine. On assumption that Amble is an associate, definitely. What is the condition? If it is less than 51%, is it right? Less than 51% till 20%, it is going to be categorized as a associate. What is the carrying amount of investment in Amble in the consolidated financial statements? Okay, how much is the cost? Just estimating a cost. We are talking about what is the value of investment. Okay, value of investment. When you are talking about the value of investment, what is the cost? Cost is how much? 240,000 shares at the rate of 6. It comes to how much? It comes to 1.44. Yeah, what is the share of profit? Share of Amble's profit. Is it right? Share of Amble's profit. How much is there? 40,000. Is it right? 40,000. We can put it as 30%. Is it right? We can directly put it as a 30%. It comes to how much? 120,000. Fine. Next, they have paid dividends. Is it right? Dividends received. Less. Yeah, less dividend. How much is the dividends? 150,000. 150,000 into 0.3. Okay, into 0.3 into 0 into 1 minute. Into 0.30. How much will get? It comes to 45,000. Fine. How much will get? 0.0005,151. Okay, we have what is the cost of the investment? 240 into 6, and what is the share of profit, and what is the how much they have dividend received. The moment you are dividend receiving, definitely the profits will decrease. Okay, next. What it says, Quartile Company is a jewelry retail business which can be assumed to be highly seasonal for the year ended 30th September 2005. Quartile assessed its operating performance by comparing selected accounting ratios with those of the business sector average. Fine. As provided by the agency. Assume that the business sector used by the agency is meaningful representation of quartile businesses. Which two of the following circumstances may invalidate? Invalidate means it will not, we cannot validate it, we cannot ensure it. Okay, the comparison of quartile with those of the average. Okay, now in the current year, quartile has experienced significant rising of cost for the purchases. We are making a comparison. Okay, we are making a comparison. When you are making a comparison, make it a point. Here we are not making comparison. Is that Quartile has expressed, fine, they have expressed. They are not talking about, we have to think about the sector average figures are compiled from companies whose year end between 1st July and 30th September 2005. What they are saying, see the thing. For the year ended 30th September 2005, okay, means if we are comparing, is it right? If we are, see, there is a comparison, is it right? Comparison, and there should be a consistency. We have covered this, is it? These are the qualitative characteristics. Comparison. Now, see, if you're taking the things, every other whichever company we are comparing within the industry, that has to be ended with what? 2005. One should not, there should be a consistency in comparison. Is it? Consistency in comparison. There should not comparison. Is it right? That's what it is. Here what will happen? It will not happen. The between means some companies will have 2000 July, some will be in August, some will be September. Definitely this will invalidate. Quartile does not revalue its property, but is aware that other entities in this sector will do. See, when other companies in the sector are doing, we have to also do. Is it right? We should not say that. See, we are doing. See, it is a jewelry business. Understand, Bhavan? It is which type of business? It is a jewelry business. When you are talking in terms of jewelry business, definitely the value of jewelry, is it right? The value of jewelry, is it right? Always are very volatile. Is it always volatile? When it is going to be volatile, we cannot say that we will not do revaluation, others are doing. Is that? It will invalidate. Is that? It will. Which two? Okay, which two? Keep it in. But you cannot say that I have completed two and I will just skip the fourth one. During the year, Quartile discovered an error relating to the inventory count at 31st 2000. The error was correctly accounted for this financial statement the current year. See, it is doing all alone. Is it right? It is doing stand alone. It is all alone. Is it right? It is a stand alone. Is it right? It is stand alone. It is no comparison with anything else. Is it right? It is no comparison. The answer is what? The answer is right? B and C. Which of the following criticism? See, conceptually we have to be very strong. Okay, I will come up with section B in the next video. Okay, time is taking from my side, but I will come up with that. Which of the following? Share it and subscribe the channel. That's very, very important. I need subscription. I need sharing the channel with those people, your friends, known people who are writing examination of F7. Okay, any ACCA examination, share with them. Okay, so that the awareness will spread. Which of the following criticism does not apply to historical cost financial statement during the period of rising prices? Is it right? Which of the does not apply? They are difficult to verify because transactions could have happened many years ago. It is a criticism. Is it? They say that which of the following does not apply. Is it? Does not apply. I mean, what it says when we are saying it does not apply, they are difficult to verify because transactions could happen many years ago. It is a historical, is it right? It is historical. Is it? They contain mixed values. Some items are current values and some are out of date values. These are difficult to verify because this is applicable. Is it right? This does not apply. This is the basically we say that the historical values is it happens. The basic financial accounting is fundamentally built on the historical values. Okay. Historical value. Well, one minute will come. They contain mixed values. Some items are current values, some are on the date values. That is the part, isn't it? Definitely you are purchasing over a year, isn't it? You are purchasing over a year. We cannot, definitely they will have a mixed values, is it right? They understate assets and overstate profits. The understate assets, fine, assets are on the historical basis, is it right? Assets will be on the profits will be on the current value basis. It is applicable, is it right? It is applicable. This is the criticism, is it? This is the criticism. They contain mixed values. This is also a criticism, is it? They overstate gearing in the statement of financial position. What is the gearing ratio? Gearing ratio is nothing but debt divided by debt plus equity. Is it right? See the thing. Debt will be on the current values. Is it right? We are taking loan every time we are taking the loan. Is it right? The loan will be on the current value, whereas equity will be on what? Equity will be on historical value basis. This is also a criticism. And what is the answer? Answer is these are all criticism applies. The answer is what? The answer is no. The following information has been taken or calculated from the Fowler's financial statement. Well, cash cycle is out. Cash cycle is the cash operating cycle is how much? 70 days. Okay. Cash operating cycle is how many days? It is 70 days. Okay. Cash operating cycle is what? Receivables plus inventory turnover days plus receivable turnover days. Is right? See, I will write here. 1 minute. Is right? I will write here. Is right? Cash cycle is nothing but inventory turnover. Okay, plus receivables minus payables. Okay, minus payables turnover. This is the cash cycle. Now what is the cash cycle? They say that 70 days. Inventory is how much? 6 times. Okay, 6 times in a year. Is that in a year? Means what is the inventory turnover days? Inventory turnover days is how much? Inventory turnover days is how much? Number of days in a year. Number of days in a year divided by turnover. Is it turnover times? Fine. 365 divided by 6. It comes to how much? It comes to 61 days. Okay. It comes to how much? 61 days. Put it as 61. Okay. Put it as 61. Next. What is the payables? Payables is how much? Payables is they are given, is right? Payables is how much? To how much? Payables are this much. Purchases is this much. Fine, is right? Payables times 365 divided by purchases. Okay, payables times 365 divided by purchases. 230 divided by 2 into 365. but 230 payables are how much? One minute. So 30 divided by 365. How much they gave us?